Hey, welcome to the Interaxis YouTube channel and Interaxis.io. Today we're going to talk about lending. Eventually, specifically, we want to get into lending in the decentralized world, in the DeFi world. But to do that, we have to take a step back and talk about what lending is. And I know this is going to sound very basic and rudimentary for a lot of people. You go, oh, I know what loans are, I know how this works. But we have to take a step back and look at all the different pieces so we see how, in a decentralized world, in a code world, we have fit all those pieces in and have to build all those blocks to make sure that it works effectively. So what happens is in the world, in the financial world, most loans are actually collateralized loans. Okay, that's we don't think about it that way. We think about all these loans that are non-collateralized, but actually most loans are collateralized by something. They could be collateralized by an asset, right? So a mortgage is a loan that is collateralized by your home or a home. You can get a car loan. You can do something that's called factoring. And factoring is basically if I know that my business, I'm going to receive a stream of income. I'm going to receive, $1,000 per month. I can go sell this stream of income to a bank or to some factoring company, and over a 12-month period where I would normally be getting $12,000, they might buy that for $10,000. Well, the benefit to me is I get the money up front and I can invest it, I can pay my people, do whatever I want, and then the bank or whomever gets this $1,000 a month. They're just buying an income stream, and that's called factoring. But all these are a form of collateralized loan. And that is, again, the most widely used type of loan in the world, in the financial world. So let's look at that, because that's kind of the first type of lending that we're trying to solve for in the decentralized or blockchain world. So let's look at, for instance, a mortgage and see how that works. So I want to buy a house, and I go to the bank, and I say, hey, I want to buy this house. This house is worth $250,000. And you might go, okay, again, this is very basic and rudimentary, and a lot of people probably know this, but we have to step through this, right? So the bank is going to look at the value of the house. They're going to do an appraisal, right? Yes, this house is worth $250,000 you're buying. They don't want to give me a loan for $250,000 to buy a house and do an appraisal and find out it's only worth $150,000, right? Because in the bank's mind, if worse comes to worse and they have to foreclose because I can't pay the mortgage, they're going to take that house and they're going to want to sell it and recoup their money. So they can't be buying a house that's worth, they can't be lending me money for a house that's worth less than $250,000. So first they're going to get an appraisal. Then they're going to do a credit report. They're going to get a credit report on me, my wife. They're going to look at income. They're going to look at tax returns and everything else, because what they're trying to assess is my credit worthiness. So my credit report is basically the companies Equifax, TransUnion. They've created these systems that look at all my credit across credit cards, other mortgages, auto loans, everything else I've done where I've borrowed money and is in this system, and they've decided here's Adam's credit worthiness, and they kind of put a number on it, a FICO score on it, and they put a number on it, but they also show a history. Right, and what the bank is assessing here is how likely is it that I'm going to be able to make these monthly mortgage payments? Because I'm paying those to the bank every month, and they're looking at how likely it is that I'm going to be able to do this. Now, in the background, they have the ability to foreclose on my home, but they don't want to do that. This is a pain. This takes time. This is a legal process. It's not like they can just show up one day and say, you missed a payment, we're taking your house back, right? They have to really try to collect from me. Then if they do eventually have to foreclose on the home, they have to go sell it as quickly as they can because they want to recoup their money. The bank is not in the business of holding a bunch of homes and leasing them out or anything. They're in the business of making loans. So they want to get their collateral back and sell it as quickly as possible. So they're trying to assess my credit worthiness because they want me to be able to keep paying this this note, right? They like earning the interest. So in my mortgage, I'm paying principal plus interest in the mortgage. And I might get a 10-year loan, a 15-year loan, a 30-year loan, whatever it might be, but I'm paying principal plus interest. I might escrow and pay my insurance and taxes and everything. But here's the deal. The bank is looking for the value here, and they're looking at my credit worthiness to decide if I'm going to get that loan, and based on that, they figure out what interest rate I'm going to pay. Now, what happens at that point is the bank now has an income stream, and that income stream is Adam's mortgage. And by the way, attached to Adam's mortgage is Adam's FICO or credit score, and attached to Adam's mortgage is this $250,000 home that we can go take if we need to, if Adam stops paying, right? Now, generally what happens is the bank will package this up with a lot of others that look similar to this and sell it to someone else. So the bank is actually factoring the mortgages, right? Because if I'm going to be paying them $2,000 a month for my mortgage, and 1,000 other people are doing that for a total of $2 million a month, the bank can go sell that to someone else, and they can get a bunch of cash, so that the bank has offloaded that risk onto somebody else, right? And they're going, no, we'd just rather have our cash. We're going to let someone else deal with collecting the money and keeping track of the value of the homes and the scores and everything else. We don't want to deal with it anymore. We did our job. Our job was to underwrite this. Our job was to appraise the house, to get the credit report, to get the credit worthiness, to give Adam the money for the first, to buy the house initially, and then go through the mortgage process for, say, the first year, and then they're going to try to sell it. Once I've proven that I'm going to keep paying the mortgage every month, they're going to go try to sell that mortgage as quickly as possible, because they want the cash. That's better for them. It gets rid of a lot of their risk. So incidentally, in 2008, when we had the housing crisis here, what happened was there had been so many loans out to people who did not have the credit worthiness, and their homes had been valued at $250,000. But what happened was, it turned out those people were not really able to pay. The banks were just trying to get as many loans out there as possible because they could make the interest pretty easily, and everyone just wanted to buy homes. And the idea was, people aren't going to default on their home. They're just not going to do it. They're going to do whatever they can to keep paying their mortgages. And when people started defaulting because they really didn't have the income to support it, and people started losing their jobs, and then they didn't have the money or the backing to keep paying these mortgages off, then what also happened is the value of the homes went down. So now I had a loan for $250,000, but my house is only worth $150,000. So even if I sell it, I still owe the bank money. If the bank forecloses, they can only sell it for $150,000. And this led to this huge domino effect that brought the whole economy down. So this is how a collateralized loan really works. You look at what the collateral is, and in most loans you're also looking at the credit worthiness, the ability to continue to repay. And because the bank, again, really wants to make sure that I'm going to have the ability, based on my income, my job, whatever money I have in the bank and everything else, to continue to pay this mortgage, because they don't want to have to come collect. Collecting on this is a painful process for the bank, and they definitely don't want to have to do it. So that's a lot of what they're doing, a lot of the underwriting process in trying to make a loan for me. So that is in contrast to the non-collateralized note. Well, you know what? I'll stick with collateralized, because that goes into the things like trade finance, right? I talked about factoring a little bit. So if I'm in the business world, and I'm, say, in shipping, or I have some products that I'm shipping to someone. So my company is shipping products to Ron's company. I might send him, I might put the products on a container, and Ron is not going to send me the money until potentially he receives them, right? So there's this time in here where these products are just out at sea or wherever, and I don't have the money. But I might be able to go get a loan or go sell this income stream to a bank or someone else, and they're just going to give me the money, and they're going to give me a little bit less, right? So if Ron's going to pay me, $100,000 for my products I shipped him, I might be able to sell this for $95,000, right? Because I want the money now. I don't want to take on this risk, so I'm offloading the risk to someone else, and that's a form of collateralized loan. As I talked earlier, another form of collateralized loan is if I know that I'm a big thing now is subscriptions, right? If I know that I'm getting, I have 1 million people that are paying me $5 per month for some sort of subscription service, I can go sell that $5 million a month for, maybe, I don't know, $100 million or 10 million, $100 million or something, and then I can go invest that in infrastructure or whatever else I need to do. But what I'm doing is there's this collateral, right? So I get the money. I'm essentially getting a loan, and whoever loaned me the money is getting paid back from my subscribers, essentially, because I'm diverting. I'm saying, okay, they're going to pay you now, they're not going to pay me. There's obviously a lot of paperwork that goes on in this process, and there's a need for these subscription payments to now go to whoever essentially factored or whoever gave me that loan. So we're having to divert payments. Now this is all going to be evident when we start talking about lending in the decentralized worlds and smart contracts. Right, so that's how it works for something like a mortgage. That's how it works for something like a business in trade finance. It might also work where if let's say I'm buying a bunch of products for construction, right? I might buy the construction materials today, but I have something like either a net 30 or maybe net 90, right? Where I don't have to pay. So this is day 1. I don't have to pay until day 90 for the products I get. So what happens is this supplier has assessed my credit worthiness as a business, and they've decided, okay, we're going to give you these construction materials, and we know that you're good for it. We know, though, that you need to build whatever you're building, and you're not going to get paid till here. So we're okay with extending you credit so you don't have to pay us until here, because we've done business together, you have this credit worthiness with us, and so this is what we call float, right? I'm able to float because I can get the products, do the work, hopefully get paid sometime between here and here. I have a little bit of profit that I get to put in my bank account, and then I have to pay for the supplies here, and I'm able to get the materials without having to give cash day 1. So that's another form of credit, another form of lending that happens kind of in the business world. The other form of loans, again, are the non-collateralized loans, and the most used, probably non-collateralized loans are credit cards, right? Because with a credit card, it's literally, I get this card and the bank is telling me, Adam, go spend what you want up to a certain limit, and you don't have to pay for it for 30 days. We're going to send you a bill, and you pay that bill, right? And so if I get a bill for $1,000 from the credit card company and I only pay $500 of it, this $500 gets charged some sort of interest rate. Okay, so it's usually a very high interest rate. They always give you that 9% or 8% introductory rate, and then it immediately shoots up to like 19%. This is a ridiculously high interest rate, but it's the ability to borrow money now so that I don't have to walk around with a wad of cash. Okay, so I can pay for everything now, and I can delay my payment for 30, 45 days or something, and of course I get some sort of rewards and all that, because they obviously want to give me the incentive to use their credit card, because they want to give me some frequent flyer miles or something, because they love getting that 19% interest on my credit card payments. And this is what jumps really fast for people, because they don't realize, if I can pay $500 of my bill, I can delay $500 more, but now I have to pay interest on top of that. And then if I do that the next month and the next month and the next month, next thing you know, I got $10,000 in credit card debt, and I'm paying 19%, $2,000 a year interest for the privilege of using the bank's money. So that is non-collateralized, and these are usually, the credit card companies know your credit history and everything else, and so as soon as you have a really good credit history, you start getting offers because they want you to use their card, and so that they can charge you this high interest rate. And the high interest rate is because they have no collateral. They have nothing, no other way to collect their money except at some point, if you don't pay your bill, they send you to a collections company, and the collections company calls and calls and calls and tries to settle and get the bank's money. And if not, then you have strikes on your credit report. And once you have strikes on your credit report and your credit score starts going down, then you have a tougher time getting any sort of loan. So the non-collateralized, the recourse for the banks is really your credit score, the effect on your credit score, which is your future ability to get any sort of credit, even collateralized credit. But there's no collateral here. You're not putting up anything to be able to get a credit card and spend money. So that, in a nutshell, is how lending works in the traditional world. And we'll see in the next video how that translates to the decentralized world. So don't forget to subscribe to the YouTube channel. Hit us at interaxis.io, on Twitter at interaxis8. Let us know if there are any other topics you want to hear about. Thanks.